Welcome to Chapter 4 in your Cornerstones textbook. Now, the early part of this chapter discusses internal controls, ways that companies can make sure that there is no fraud happening in their companies and make sure that they are accounting for mistakes and catching them quickly, and also making sure that employees stick to their roles. I would encourage you to read the first part of the chapter very carefully and go through the PowerPoint presentation that's available on Moodle. There will be no video that discusses those items in particular. This video will focus specifically on one of the cash controls that we call the bank reconciliation. Now, why do we do a bank reconciliation? Well, we do it regularly, as in monthly, because the bank records and the company's records will often disagree. They might disagree because of timing differences, because of mistakes on either the bank's part or the company's part, as well as transaction differences, ways that things might actually be recorded. So every month, a company should take their bank statement and do a bank reconciliation, which is the process by which the differences between the accounting records of the company and the records of the bank are harmonized. Now, what kind of info is found on the bank statement? Well, it's a monthly record of what happens in your bank account, according to the bank. Now, one of the trickiest parts of a bank reconciliation is understanding the ways that a company thinks about debits and credits and the way the bank thinks about debits and credits. On the company's records, as you have learned in chapters 1, 2, and 3, the cash account is an asset account, which means it has a normal debit balance. Any increases in a company's cash account, its checking account really, would be debits. They would be recorded as debits. However, according to the bank statement, any deposits into the company's checking account or cash account will be listed as credits. Now that's sure to confuse you. Why is that? Well, that's because from the bank's perspective, any money that a company puts into its account is an increase in a liability for the bank. Remember, all the money sitting in the cash accounts, the checking accounts, for all those different accounts at a bank, those are all what we call on-demand accounts. That means at any moment, if the customer walks into the bank must be able to produce enough cash to cover the full amount of whatever is in that checking account. That, from the bank's perspective, is a liability. From the customer's perspective, is an asset. So you just sort of have to understand the difference between how the bank looks at it and how the company looks at it. The same thing goes for cash withdrawals. Every time a check is written by a company, that's a withdrawal from its checking account or from its cash account. On the company's own records, those cash withdrawals would be listed as credits, right? Because they would be a decrease in an asset account, the cash account. But from the bank statement, every withdrawal from your checking account is one less dollar of liability that it has. Well, if I decrease a liability account from the bank's perspective, that's a debit. So on your bank statement, the bank will show that for every withdrawal, it's listed as a debit. Try not to let those differences confuse you. When you're reading a bank statement for your company, deposits will be called credits. But make no mistake, on your company records, every deposit should be a debit entry. Okay, what are some of the differences between company and bank records? Well, transactions that might have been recorded by the business maybe did not make it into the bank in time or did not clear the bank in time for that month's statement. There also will probably be some transactions recorded by the bank that were not yet recorded by the business, and like we said earlier, there could be errors by either the bank or the company. Here are some of the transactions that would be recorded by the business during that month, but not yet by the bank. The first major one would be outstanding checks. These would be checks that were written or issued by the bank, by the business, and recorded by the business on its accounting records, but they haven't cleared the bank account because the recipient of the check has not negotiated the check, meaning they haven't taken it to the bank. The other major difference, a transaction that the business would record but the bank would not have seen yet, would be what we call a deposit in transit. It's an amount, a deposit amount that was received and recorded by the business, but for some reason the bank did not record it in time for that month's bank statement. As you may know, sometimes the day you deposit your check, the money does not actually get to hit your account. It could depend on where the check is written from, what state it's written from, what time you deposited, things like that. That's what we call a deposit in transit. Now, there are multiple kinds of transactions that might have been recorded by the bank, but they're not yet recorded by the business. That would be things like the service charge that the bank may charge you for having your checking account. One of the big ones might be non-sufficient funds checks or NSF checks. These are checks that you, the company, tried to deposit. They were issued to you by some other person or company. You deposited them, but unfortunately the person who issued them to you did not have enough funds in their bank account to cover that amount. That means you don't get the money. Other items might be what we call debit or credit memos. Some of you may have automatic debits coming out of your checking account for monthly bills, things like that. Those might not have already been recorded by the company, but they are items that have already come out or gone into the account. Now, in order to do a bank reconciliation, one of the easiest things to do is to set up a 2-column sheet. And at the top of the left column, you would write the balance from the bank statement, whatever the ending balance for that month is. At the top of the right-hand column, you would write the balance as you see on the cash account for your company records. Now, on the left-hand side, you would add any deposits in transit, deposits that you had recorded on your company records but had not been shown on the bank statement. You would subtract any outstanding checks and you would get the resulting sum at the bottom that you'd call your adjusted cash balance. On the company record side of your sheet, you would add any credit memos, any automatic deposits into your checking account that you had not previously recorded, any interest that you might be receiving on your checking account, and any errors, meaning any errors in how you had recorded a check, especially if you had misrecorded the check with a higher amount. That means you would have mistakenly thought more money was coming out of your checking account than actually came out of your checking account, so you'd need to add the difference. You would also want to subtract any debit memos, any service charges, any NSF checks, as well as any errors on checks you had recorded where you recorded a lower amount than actually came out of your bank account. After doing all those adjustments, you would sum the total at the bottom, and hopefully the adjusted cash balance on the bank statement side of your reconciliation would equal the adjusted cash balance on the company record side. Now, once you have done your bank reconciliation, you need to make adjustment entries. Be careful. Don't get too crazy making adjustment entries. You do not want to make adjustment entries for any outstanding checks because you've already recorded them. Those were just things that you did not yet see on your bank statement. But you don't want to make an adjustment entry because you'd be double counting a check. You also do not want to make adjustment entries for deposits in transit. You do want to make adjustment entries for any errors in checks that you discovered after looking at the bank reconciliation, any items not in the company records like bank charges, interest amounts, NSF checks, and any debit or credit memos. So let's go to Cornerstones 1 and 2 on pages 184 and 185 in your textbook. And we will look at Ohio Enterprises bank statement in its company records. First, we'll complete the bank reconciliation, and then we will prepare all the adjusting journal entries. Now, this is Ohio Enterprises bank statement. This is a printout of their cash account, all of the entries that would have been made during the month of August. Now, the first thing you want to do is compare deposits. According to the company's records, there were 3 deposits. A deposit $26.73 and 10 cents. Was that on the bank statement? Yes, it was. And I would just put a little check right there. When I do bank reconciliations, I take a pencil and I make these little checks. There was a second deposit for $4,500 according to the company records. Do we see that on the bank statement? Yes, we do. There was a third deposit for $300. Do we see that on the bank statement? Oh, no, we don't. And since I wrote in pencil, I can erase. I have a deposit in transit for $300. Now next, we would want to compare every single check that we believe was written on the company account during the month of August. Now, if you notice, there's 2 sets of information here on the company records. Starts with check number 1886 and ends with 1905. What you would need to do is you would need to go through every single one of these checks and compare it to the bank statement. Make sure that that check number had actually come out of the bank account and it was for the correct amount. Pause the video and take yourself through the bank statement and the company records for all of the checks to see if there were any outstanding checks or any check errors during the month of August. If you looked through that very carefully, you would have discovered that there were 3 outstanding checks, 1901 for $93, 1904 for $72.50, and 1905 for $891. You also would have discovered that check 1898 was actually only for $78, but the company records had recorded it for $87. The company had recorded a number that was too high by $9, so that would mean that they needed to add $9 back into the company records cash account. Now that covers outstanding checks and deposits in transit, as well as one of the company errors. Let's see if there's anything else on the bank statement that does not appear on the company's records for the cash account. Well, the first thing I see is an interest amount that should be added to the company's cash account for $2. I also see a debit memo for $380, an NSF check for $200, and a service charge of $14. Those 3 items will need to be subtracted from the company's records cash account. So let's fill in. Notice I've got a 2-column bank reconciliation. At the start, I'm going to put the cash balance directly from the bank statement. Let's go back. Where is that? Well, the current balance as of August 31st, 2011 is $4,165.04. That's from the bank statement. 165 and 4 cents. And what was the balance as of the end of August from the company's records? Well, it's right here. 3991.54. 3991.54. Now, I'm going to add any deposits in transit to the left side of the account, as well as subtract any outstanding checks. And then to the right side, I'm going to add that check error where I had over-recorded. I'm going to add the interest, and then I'm going to subtract the debit memo, the NSF check, and the service charge. So let's look at that bank reconciliation. Remember, I started the left-hand side with the final balance from the bank statement. I'm going to add deposit in transit of $300. I'm subtracting the amounts of those 3 outstanding checks, and I come up with an adjusted cash balance of $3,408.54. On the right-hand side of my reconciliation, I have a cash balance of $3,991.54. That's what I got from my company records as of the end of August. I'm going to add the error from check number 1898. I'm going to add the interest. I'm going to subtract the service charge, subtract the amount of that non-sufficient funds check, and subtract the debit memo, which was for the electric bill. And I'm going to come up with an adjusted cash balance of $3,408.54. Notice these two equal. My bank statement and my company records have now been reconciled. Finally, I have to make adjusting entries. Now remember, we do not adjust for deposits in transit or for any of those outstanding checks. Those are already accounted for in the company records. What I do need to do is make adjusting entries for the check error and the interest, both of which should add money to my cash account, right? If I'm going to add amounts to my cash account, those are going to be debit entries to cash and credit entries to something else, right? And I need to adjust for service charge, NSF check, and debit memo. All of those were subtractions from my cash account, which means those are credit entries. So the other side of those journal entries will be debit entries. Let's look at my additions to cash. I had a $9 check error that added $9 of debit to my cash account, and it was a $9 credit entry to accounts payable. Remember, it was a check the company had written, presumably to pay off some accounts payable. That means we had initially over-debited accounts payable. So we've got to put a credit back in there of $9. When it comes to interest income is a revenue account. So we have a $2 credit to interest income and a $2 debit to cash. Now let's look at those reductions to the cash account. I had a bank service charge. Well, that's an expense, so that's going to be a debit to bank service charge expense, and it was a credit to cash. I also had that NSF check. That was a check written by another company to Ohio Enterprises. That company apparently wasn't able to pay that check. They didn't have enough money in their account, which means the accounts receivable that $200 check was supposed to be paying off is no longer paid off. So we have to put $200 back into the accounts receivable account. That's an asset account, so it's got to be a debit to accounts receivable. It's a credit to cash. And lastly, that debit memo was to pay off the electric bill. Well, that's a utilities expense. An increase in an expense is a debit. It was $380, and it reduced my cash account, which is a credit to cash of $380. That is how we do the bank reconciliation and the adjusting entries.